Ladies and gentlemen, welcome back to the Capital Flows podcast. In today's session, I'm going to provide an update about the views that I've laid out for the developments of the macro regime, and then cover some other thoughts for where we're at in ES and bonds and how we should think about those as we move into the next 90 days. So, if you go to the Capital Flows Research website, capitalflowsresearch.com, all of the research and educational primers are here. You can put your email right here and get all of the most recent research that's going to get sent out every single day. On the main page, you have the first article that is a synthesis of all the educational primers covering every aspect of macro and every major asset in markets. When you combine these two things together, you get a clear picture of what is taking place, why it's taking place, and how to act in light of that. So that has all of the resources. There's a pretty good number of resources in there with a lot of book recommendations. So being able to read through all of those is actually going to require some investment and work. And that is going to be, on you. I made all these resources and the primers so that they're free. All it requires is you to put in the work. And that's how basically most things are in markets. So those are all the educational primers. And then the recent developments that have taken place are the equity market update, the trades that I've opened, and then also the risks for China and the geopolitical implications on global liquidity. I'm going to connect to the update on equity markets because about a month ago I explained that, or a couple weeks ago now, I explained my view on equities and how it shifted. In November, I explained that I had a neutral view on equities, and then that last week, moving into the inauguration, that I started running shorts and betting on the tail, mainly with out-of-the-money put options, and explaining the logic behind that, especially how it connects to where we're at in the macro regime. As we have moved through several catalysts this week, including the unwind on Monday, where we had the gap down and the DeepSeek news, we had the FOMC meeting, and then we also had several earnings releases for Mag 7. We had the collocation of all of those things stacking up together, and the signals that took place during that time have shifted the view for equities. And while I'm not necessarily having the view that we're going to have an absolute melt up and that this is going to be another year kind of like 2024, we're going to have to be a little bit more tactical. But on a positioning basis and the signals that have taken place, especially the fact that Powell did not come out super hawkish in the FOMC meeting, and now that you're seeing the curve bull flatten a little bit, those are all signals, and those are all coming together as credit spreads are still at lows, and those are coming together to shift the view on equities. We've had a pretty significant drawdown in the Russell, and now, we're seeing credit spreads still remain at lows. The bull flattening, you want to compare that with the Russell and how things are moving there. And then on top of this, we've seen a fall in FX vol. We're still seeing USD CAD 1 month implied vol rise and divert. A lot of that's around the news regarding the tariffs and things like that from the new Trump administration. But overall, FX vol has been falling. When you have that FX vol fall and you move through these macro catalysts that function as clearing events, lower volatility always allows more capital to move out the risk curve. That's just how it works mechanically. So all of those things have come together in line with the carry trade beginning to consolidate and not make pretty significant low like in August of last year. And so those are the main ideas that have taken place that have shifted the views for equities, and those have been laid out. And like I say over and over, and I even laid this out in the equity report, the most important thing you can do for any view is have a redundancy plan and break that down for how things are likely to play out, and just say, if it goes here, my view is right. If it goes here, my view is wrong, and then you just change it. And there's nothing wrong with changing your mind. And so I think that's a great way to kind of think about the equity position. And then if the macro forces begin to shift again, and my strategies end up going bearish equities and begin running shorts again, then I'll just do that. So that's how to think about the macro regime right now. All of the tear sheets are right here, and these break down all of the major developments that are taking place in the macro regime in the FX market, on equities, for fixed income, and then also for crypto. And so you want to be able to follow all of those as well. I'm going to shift back to the recent trades that I opened for paid subscribers, and I will cover just the charts that we went over in the article. This is a chart of the credit spreads in white in the United States and then also inflation swaps. What you're noticing is that there's a divergence taking place where inflation swaps are pretty elevated and they're moving up. And I would say, I would actually say they're consolidating in this period of time. I don't know if we're going to get that much higher given where rates are, but we have been consolidating and we're not making a durable move down yet. At the same time, credit spreads are remaining at lows as you have the 10-year pushing up. Until that correlation flips, until that correlation flips and you begin seeing a higher dollar as a response, then that short equity view is unlikely to have a high risk reward. So once that correlation begins to shift and we have macro information and macro data confirm that, and a stance by the Fed that is unlikely to be correct relative to the macro situation, that will frame the trades that take place. As a result, since we have inflation expectations just a little bit elevated and you have this set up by Powell, you probably have limited upside in rates on the short end right here. So in my view, you probably have limited upside on the 2-year interest rate, and we have consolidated to, at this level to make a lower high in the 2-year compared to 2024 and 2023. So those forces are coming together to have a little bit more of a technical level right here that is providing a higher signal for where we're likely to be. Just because we have limited upside doesn't mean the downside for interest rates is beginning to increase. That's the key to think about for running trades in this regime. And then I'll also cover, I've seen some recent notes about the Atlanta Fed Nowcast. The most recent move down is primarily from the wholesale inventory input in the monthly data for wholesale inventories. And, overall, when you think about the Atlanta Fed Nowcast, there's a lot of movement in the inventory component and the export and import component. For a growth shock, you want to see the investment portion and the PCE components move down. Right now, fixed investment is actually accelerating. So, again, not really the kind of risk that people are talking about because you always want to look at those underlying components. We're still seeing the 10-year, be at an elevated level above inflation swaps on a relative basis in terms of returns. And so that is going to be a key thing that's probably going to keep a lid on inflation expectations. So we're probably not going to see a huge acceleration. All of the trades connected to this are laid out below for paid subscribers if you want to go over those. And I'll be sharing some additional ones as we move through this week. The final thing that I want to talk about before we go is the risk of China and its geopolitical implications on global liquidity. If there are two recent threads that you should read and that you must read on the development of the China situation and the risks that exist, it's the one by Josh Wolf and then also Brad Setzer. Both of them really clear thinkers and really well thought out views from their respective specialties. Brad is probably the go-to person to model all the data in China because the data over there is just such a mess, and he does a great job at explaining and going through how to model that data properly. And then Josh Wolf also explaining a lot of good things from a geopolitical perspective in terms of the more qualitative aspects for how things are developing. And the thing that Josh laid out is that, the China playbook isn't war in the open, it's war in the seams. They target gaps between state and federal, public and private, markets and security. And America must armor up. Their strategy to hollow out the U.S. strength from within. Critical infrastructure, infiltrated. Universities, compromised. State pension funds, financing Chinese military tech. While America focused on the war on terror, China waged war on us, a silent siege of intellectual property theft, capital capture, and digital espionage. Now the bill comes due. I would, broadly agree with the way that Josh lays out this view, and I've really appreciated a lot of the things that he's laid out in his tweets and some of the interviews that he's done. I would encourage everyone to, follow him and check him out because the situation that you have where, China is targeting different types of silos or gaps is really critical, right? Where you have a pension fund that they're just trying to meet their, liabilities and they meet their returns, and they'll provide capital to people if there is a high enough return, and then they can match that with a geopolitical incentive or a political incentive to infiltrate things in some way. All of these things is very subtle. People aren't really talking about it a ton. A lot of the people that maybe are talking about the conspiracy theories connected to China more, they keep on having these implications from a perspective that is connected to, maybe outright physical violence, when in reality, it's, the wars waged today, 95% of them are in the clandestine sphere. So you have to think in those terms, right? Which is asymmetrical warfare, informational warfare, and things along those lines. All of these ideas are quantified in the geopolitical flows, in the balance of payments that exist between the U.S. and China. And Brad is the expert on explaining these flows and going through them and modeling them actively. So he is, basically the best guy out there modeling all of this. And I would also encourage people to follow Michael Pettis and read his book, Trade Wars or Class Wars, because that is probably one of the most definitive works on explaining that relationship in recent history. I think it was published in the last couple of years, and it explains the weaponization of the balance of payments that China is using right now against the U.S. and why that matters for global trade, for goods and services, and for everything from a geopolitical perspective. As this has taken place, Chinese equities have, basically made a bit of a bottom, and they're still in the low end of the range for valuations, as the U.S. is the opposite. And this is connecting with flows in equities. Primarily, what we've seen over the past week is, the MCHI ETF, rallying against the semiconductor space, right? And a lot of this is because AI and crypto and all of these things are linking together, and the differentials that are taking place between the US and China are now taking more of a dominant role in how things are developing. So this is the article that I laid out, how the new administration is a massive risk for crypto, how that connects with AI and things along like that. We're already seeing a integration of AI and crypto in things like the Virtuals protocol, where AI bots are converging with crypto. And while the market cap is still small and low, you're beginning to see those things converge as AI bots send crypto back and forth to do tasks for each other. And there's a lot of qualifications for that, but the space is something to actively monitor. So all of that is being addressed by the new administration, especially with the new news from DeepSeek. And the AI news about DeepSeek is making explicit what has been implicit for years between the US and China. And so now everyone's kind of talking about these risks again, especially, I linked here a note by David Sachs and how he's covering that. He's the new crypto kind of head for the Trump administration, and he's also talking about AI, mainly because those things are obviously overlapped and they're integrating more and more. So I'll end with this book, Trade Wars or Class Wars, by Matthew Klein, Michael Pettis. Matt has a great Substack I would encourage everyone to go check out as well. I think it's called The Overshoot. Great, breakdown of the things that are taking place in the overall economy, especially on a global basis. But those are the main ideas. I'll be publishing some more research later today and explaining some more macro views, so keep an eye out for that. And I will see you guys soon.